Okay, good afternoon all, and welcome to the first BizVal webinar for 2023. Hopefully you all had a good festive season if you're in South Africa and a good break. And for those of you joining from outside of South Africa, welcome. I'm Graham Stephen, the co-founder and CEO of BizVal, and once again I'm joined by my co-founders Howard Blake and the Finance Ghost. Today we'll be easing into the new year as we share some insights from Howard, share a bit about our new valuation scenario tool, which we've just launched, some stats and observations from the BizVal platform over the last few months. And we're going to dive into, and the Ghost is going to dive into why we believe the discounted cash flow method is such a powerful tool in valuing businesses. Some quick housekeeping. We're going to have our formal presentation, which will be around 25 minutes, followed by the usual Q&A for further 20 to 25 minutes at the end. Please feel free to send any questions that you like in the chat. You don't have to wait until the end. You can pop them there now. And just so you all know, the chat section is set to private, so only the presenters and moderators can see your messages in the chat. We will be recording the webinar. So, we're based in South Africa, so load shedding happens at inopportune times. So the webinar will be recorded. It will be available on YouTube. And if you're registered, you should get a reminder through email about being able to watch the recording. So if something comes up, load shedding, or you need to drop off the call, it will be available shortly afterwards. We also have a poll running. So if you click on the top right-hand section of Demio, please check out the poll and click your response. And the question for today is, have you ever had the value of your business formally appraised? So if you can check that out, and during the course of the webinar, go and answer those questions. So we're going to mix things up a little bit. We're going to start off with Howard today. And Howard's going to share some practical insights and lessons on how and why valuations have been so important to him over the years, and also how they're so important to entrepreneurs, as they embark on their journey. So without further ado, I'm going to hand over to you, Howard.
Thank you, everybody. And I think in these sessions, we try and bring you very practical insights from my own experience, which spans over 40 years. And I've only ever been an entrepreneur, really. So the insights we bring you, we feel are very practical. It was also the passion behind why we started BizVal, so that we could bring the art of business valuation to a much wider audience at a price point that allowed more people to interact and benefit, and hopefully grow their enterprise value to a point where they could either benefit from a sale or a nice EBITDA-rich business. So in preparation for today, I interviewed 4 fellow entrepreneurs just to get a sense, and I try to get as diverse as possible. So we're looking at people who are involved in the medical area at an enterprise level. These are enterprise relevant organizations, transport and agricultural interests. So I really got you a wide spread to be able to see how it goes. And the question that we asked them was, were you enterprise value focused during the growth of your business? And the unanimous answer was no, they weren't. So everybody, I think, in the entrepreneurial journey, the biggest milestone is that first net profit. The first milestone of relief is when you are able to break even, and from there onwards it's growth. But what happens is entrepreneurs are always so busy growing this business and getting involved in the detail of the growth of the business, they sometimes lack a true north heading. And the true north heading in any enterprise is its value, and growing its value in a structured way. Now,
sorry to interrupt your flow. Can you perhaps, there's a few comments, if you can maybe just speak up a little or move a little closer to the mic. I think a few guys are battling to hear you.
Okay. Is that better, Graham?
Much better, thank you.
Okay, so what we did is when we interviewed people, we asked them, how would you be able to set the true north in growing your enterprise value? And they all agreed that if they had understood what the value drivers were, they would have grown a lot quicker and in a fixed direction. We all know as entrepreneurs, one of our biggest risks is that we lose focus and we run down little rabbit holes that basically divert our attention from the focus and the goal. Understanding your enterprise value and understanding the value that you build gives you the kind of focus that allows you to drive your business quicker and in a determined direction to build that enterprise value. And we feel that this is something extremely important, and this is one of the things that our product helps you to do. I mean, Ghost's going to speak to us today about discounted cash flow and how that works in building value. And this is something that is very, very important. Strong cash flows equals great EBITDA. Great EBITDAs get great multiples, and that builds your enterprise value. So we look forward to the discussion today in building this true north. If I can just keep coming back to this, the true north of value creation in a business is understanding your value drivers and tweaking them to be able to get you to that enterprise value that either gives you great dividend flow or a great exit on sale. Thank you, Graham.
Howard, thanks very much. And I think it leads us nicely into kind of the next brief part of the discussion. And as you know, the valuation is really just a starting point. So without this being a sales pitch, I would like to just kind of tell everybody about what we've just launched. So the valuation is a starting point. And as we know, no sooner than you've solved one challenge or one problem or one opportunity, then another one arises. So that's precisely why we've developed and launched our scenario planning tool. This is a free add-on that's available to any customer performing a live valuation through BizVal. And it allows you to answer that what-if question. What happens if my growth rate changes? What happens if I increase my markup? What happens if I reduce costs? So, there's various questions that we might ask. And we believe that this gives a great additional insight that allows you to move beyond the current status quo and start to think ahead. So if you could just, on the screenshots, we're not going to go into any detail here, but as you can see, once you've done a valuation, you can now go and complete scenarios. It's an option on our website. What it does effectively is it shows you all the inputs that you captured on your original scenario, and there's a bunch of sliders that you can move along to change your revenue, your various inputs. And once you've done that, you click run, and it then compares your original valuation versus what the estimated valuation would be if those parameters and those drivers change. So, we think that that's a neat way to enable you not just to get a current status quo of your valuation of the business, but also to start thinking ahead. I'm briefly going to share just a few, before I hand over to Ghost, I want to share some of the insights and stats from the BizVal platform. So we launched BizVal in July 2022, and I must say we've been completely overwhelmed by both the support and the feedback we've received over this period, and we celebrated this by running our successful Reflect campaign over December. So obviously all the information that we're showing, all our core information is strictly confidential. It's behind encrypted firewalls and all those things, but what we are able to share are some aggregate level insights. And today we're just going to show a bit of a teaser to whet the appetite, but going forward, we're going to share deep insights around the real SME economy, not just in South Africa, but in other countries that we use the tool and as we expand globally. And what this does is gives a real view into sort of the underbelly of the SME economy, unpacking things like employment numbers, growth insights, what separates great businesses from ordinary businesses, and more. And we're going to be sharing these across our various channels, future webinars, and our platforms like LinkedIn and Twitter and all those sorts of things. So it's intended to be practical, informative, and interesting to help you grow and strengthen your business. So very briefly, I just want to share some top-line insights with you. I'm not going to spend too much time on this, but to date, we've done over 150 valuations. It's closing in on 200, with a total enterprise valuation of about 10.6 billion rand. So, I think that's surpassed our expectations from, when we launched in July. We were kind of just feeding the waters, but it's been remarkable. We've actually had a valuation for 2.4 billion, which is our highest valuation. And safe to say, it's actually a small cap business, which was within 10% of the BizVal valuation. So we were really proud of that our tool can work for both smaller businesses right up to businesses which are nearing a listing stage or very big private companies. I think what's also super interesting is that, we have our concierge offering. Now, obviously, the live offering is our core product. It's out there for you to go and be able to do your own valuation in a matter of minutes. But we have found, just over 10% of customers actually want a little bit more. They want us to go and give a bit of insight into what the valuation is telling them. They want a human on the other end of the line, so to speak. So that's been incredibly popular, and we're starting to see some real good engagement coming through that channel. And also across countries. So we primarily launched in South Africa and the UK at this stage, but we've had from Mozambique, Namibia, a number of other countries. So just watch the space as we go beyond the borders of our country and our time zone, so to speak. Just a couple of interesting snippets. So what has been super interesting for us is that, it's been across a range of sectors. We've had valuations probably across 20 different sectors. The sort of top sectors seem to have been concentrated around financial services. We've got restaurants in there, manufacturing, industrial, chemical businesses. So incredibly diverse, and we're getting great feedback and great outcomes from all these different sectors. And I guess the last point I want to touch on is, just the size of the valuations. So as you can see there, the IT sector, and maybe this has changed after all the layoffs across Google and Apple and all these companies over the last few weeks. But the IT sector kind of leads the way in terms of enterprise value. But as you can see, some of the other sectors performing really well there. Before I hand over to Ghost, I just want to touch on one last snippet of insight. So as I said, we have our poll running, which we do every webinar. And we haven't shared these insights, but from the last 4 polls, and I apologize if the writing's a little bit small, what we've seen from that is that many of you listening in on these webinars are entrepreneurs and business owners yourselves. So over 50% of people engaging with us are business owners, not just people supporting that. And I think one of the biggest insights from us is that the hustle of building sales and building the sales funnel, tracking that conversion and driving sales is probably both the biggest challenge and the biggest opportunity for business owners alike. And that's quite important, because that's really where the valuation starts. If you don't have revenue, you don't have a business. And I think we touched on that in one of the earlier webinars. So just some snippets from the BizVal platform to date. As I said, we're going to be going deeper. We have our newsletters and everything, and we're delving deeply into, how SMEs are performing and some of those insights going forward. So enough from me. I'm going to hand over to the ever-present and secretive Ghost, and he's going to delve into some of the thinking behind the DCF model that we use and some other elements around valuation.
Thank you, Graham. Not so secretive anymore. If you were listening closely to Howard earlier, he nearly let the ghost out of the bag. But rule number 1 of startups, don't get upset with the guy funding it, no matter what he does, because otherwise you're in serious trouble. So Howard, I forgive you. And, those who were listening carefully, good for you. Those who were not, now you'll go back and listen again. Anyway, let's move on, shall we? So welcome, everyone. It's our first BizVal webinar of 2023, and I always get the fun job of taking you through some technical valuation type concepts, and that always means charts. Well, not always, actually. We've done all kinds of cool stuff on recent webinars, but today it very much means charts. So the whole idea today is to actually show you why we think discounted cash flow methodology is the way to go in terms of giving it the highest weighting when we do a valuation. So our proprietary algorithm actually uses a few different methods, but the discounted cash flow is the one that we give the highest weighting to. And I want to show you why today. So, we'll talk shortly about what's on the screen, but if you go to Claremont, if you go to Rosebank, if you say the acronym DCF, a lot of people there will know what you're talking about, a discounted cash flow. These things are complicated to build. They are fraught with danger in terms of very easy mistakes to make. It's not super easy to teach yourself how to do a discounted cash flow, because the problem is, unless you've done a lot of them in practice, you won't always appreciate how sensitive they are to certain inputs. If you change a few things in a DCF, you can come out with some crazy answers and not fully realize why. However, they do come with some benefits. So, they do the right stuff in terms of understanding how cash is generated by the business and actually ends up in the hands of shareholders. They start from revenue and they end up in the cash literally being paid out as free cash flow. Working capital, capital expenditure, it all gets taken into account in a DCF. So Y is an earnings multiple chart of the Fashini Group, and I fully approve of their trading ticker, TFG, for obvious reasons. They stole it from me. I'll have to be more creative when this lists one day. Why is there EBITDA multiple on the screen? So the point is, an earnings multiple is really just a mathematical ratio of two things, right? It's the market price, depending which ratio you're using, and the company's numbers. So the simplest one is to just do a revenue multiple. So literally price to sales. This is how people used to value Netflix. Those people have lost half their money. It doesn't work. Then there are other ways to do it where you can do stuff like EBITDA multiples, which uses effectively a proxy for operating profit. That's what's on the screen right now. You can use the PE multiple, which everyone seems to know about. You know, in South Africa, you take headline earnings per share and you compare it to the share price, and that gives you an idea of the price earnings multiple. All good and well, unless things go a little bit mad. Now, as we know, in the last couple of years, the world went more than a little bit mad. And if you look at that chart, you can see the multiple was kind of skating along 10x. I don't know if you should be able to see that line, you know, in 2018, and it dipped a bit as we kind of got into the pandemic because people realized, oh, we're in trouble. And then this wild spike happens, sort of May 2021, just straight up and then straight down again. Now, what does that actually mean? You know, it means that this multiple looks crazy, right? Did TFG suddenly become 3 times more valuable overnight? No, definitely not. And we can see that with the share price chart. So Graham, if you flick to the next one. So there we've highlighted that section and how it corresponds to the share price chart. Now, as you can see, the share price did not go 3x overnight, clearly. So what's going on here? Why did the multiple do that when the share price didn't? So all that would have happened here is the Foschini Group would have reported numbers that actually reflect the horrors of COVID. So what happens is profitability takes a massive knock. So that's one part of the ratio. But the share price kind of already knew this stuff, right? Because the share price is a leading indicator, whereas financial reporting is historical. The share price knows what's going on out there right now. We'll only find out what the effect of the numbers is when they report their financials in 6 or 9 months' time. So actually, you can see the share price nosedived long before that and then only came back. And by the time it came back, you know, people knew what was happening in the business. So the problem here is clearly trailing multiples, and that's when you use the last 12 months financials to work out the multiple, comes with a serious issue in that it's actually using numbers that are really old. What are people doing in the market when they value these businesses and they invest in them? They're actually looking at what's called a forward multiple, which means the expectation of earnings over the next year compared to today's price. It doesn't help you to pay for something that already happened. You've got to pay for what's coming. What else do they do in the market? Well, institutional investors will use discounted cash flow methodologies because once again, they are forward looking. And that is what drives the share price. So, you know, where would that leave us if all we did at BizVal was take a market comparative? So let's say you came on to the system and you wanted to value your clothing retail business. And we said, okay, great. What is the current listed multiple of the Foschini Group? Well, that wouldn't have worked so well if we did it during that period because we would have been valuing your business at 30x less a discount, which I think we can all agree is not so smart. So TFG, it's easy to spot that something went crazy. It's not always so easy. Graham, if you go to the next one. So if you think the markets are rational, then I have a Ponzi to sell you, definitely, as the old joke goes. Markets are not rational. They are driven by human emotions, central banks, swings in sentiment, global geopolitical disasters, and many other things that regularly throw them into chaos. That's what makes it so fun, right? That's why I love them. So on the screen, we have Nike's EBITDA multiple. I think we can all agree Nike's a pretty big business. And again, even there, the EBITDA multiple does crazy things. You can see those one-day moves, and that's again around the time of COVID, and that's exactly for the reason we've discussed with the Foschini Group. However, look at the average multiple. You know, in Foschini, it was super obvious, right? It like went up and like a month later or 2 months later, it bombed again. This has done it a little bit more steadily. And there was a long period where it was a very elevated multiple. So in this case, when you see multiples that are very high like this, you need to say to yourself, okay, did the earnings fall sharply? Is that why this broke? That's why it broke in the Foschini Group. But if we go to the next slide, then you'll see that that's not true for Nike. Yes, there was one quarter, and this is their EBITDA per quarter. So I keep using that acronym. I'll explain it once. It's earnings before interest, taxes, depreciation, and amortization. Now that I've confused you even more, it's a proxy for operating profit, basically. It's just accountants get very excited about this stuff, and it makes them sound clever, but it's operating profit. So you can see in that first quarter of the lockdowns, the operating profit actually went negative. Yes, Nike made a loss. And then suddenly their direct-to-consumer strategy, which we actually spoke about in our last webinar, you know, kicked in. They were selling shoes online. People were buying the shoes even though they would get arrested if they tried to wear them outside. It worked. You can see it worked. The earnings were fine. So why did the multiple spike like that? Clearly, it was not because earnings fell apart. So that means that something else was going on in the market. Graham, if you go to the next one, that is the danger right there. That is a Nike share price chart. That is the danger right there of buying into stupid multiples. So look at the share price in sort of 2021 to 2022 and look at where it came down to. Now, I've been flattering to Nike by choosing a longer term chart here because I wanted you to see that over 5 years, Nike has still been a good punt, without a doubt. That 14.4% CAGR that you might be able to see there, that stands for compound annual growth rate. And basically that means that, over that period per year, Nike has returned 14.4% in dollars, and that always excludes dividends. So your money would have been very happy in Nike unless you YOLO'd into the stock, in late 2021, in which case you saw your money halve before it started to turn again recently as momentum improved around China and sentiment and all of those good things. So it's possible to buy shares in Nike and see your money halve in value. Why? Because the multiples were completely insane. If you just went and looked and used a little bit of common sense, you would have seen, okay, these multiples are clearly being fueled by insane stimulus in the market. You don't need to do a lot of reading on macroeconomics to understand what was going on out there. And those multiples just do not make sense. Again, imagine if we had gone and said, cool, we'll value your business relative to Nike at a time in the market where the valuation multiples are just not realistic. And suddenly we tell you, no, we think your shoe business is worth 30 times earnings. I mean, if someone walks in and offers you 30 times earnings for a private company, the correct answer is yes, I'll take it. Unless you're a startup and that earnings base is no reflection, of what your business is actually capable of making. So there are some lessons here for valuations, and I just want to touch on a few of them. The first one, multiples tend to exhibit mean reversion unless there are excellent reasons for that multiple to have structurally changed. So what that means is if a business has always traded at between 10x and 12x, and now it's suddenly at 18x, it's probably going to hurt you unless there is a very compelling reason why that business should be trading at 50% more per rand or per dollar than it used to. What has changed to justify that? Sometimes there's a reason, for sure. There's a turnaround strategy or the business is just better overall, but it's just difficult. Then the second point is multiples always need to be compared to the underlying earnings and how sustainable they are. So when we're valuing a private company, we always look at stuff like, what happened that year? Are those earnings a reflection of what is actually going on in the business? Are there once-offs involved? And that's where our concierge offering comes into this. Are there things we need to specifically adjust for to say, this is maybe not an ongoing reflection of the earnings in the business. Just be careful. Should we be valuing this on a specific multiple? And perhaps the third point is you just can't blindly take listed company multiples and apply them to private companies, even when you are going to apply discounts. You just can't do it. And the reason you would apply these kind of discounts is you would say something like, the Foschini Group is trading at 15x. What would a private company trade at? Well, it has less liquidity. It doesn't have as established a governance process. There's obviously more risk in a private company. So you would typically then apply discounts to whatever that listed multiple is to get to the answer. But the problem is if that multiple in the market is silly to start with and irrational, then guess what? It's going to give you a really irrational answer for a private company. If the starting point of your calculation is nonsense, the end result is going to be nonsense. And all of that is why we like to do a discounted cash flow for the businesses that we value. It's why our offering asks the people valuing their business, what are your own growth expectations for your business? How do you actually turn revenue into cash? What are your sort of typical debtor days and creditor days? What are your margins? We ask a whole bunch of questions. And in the background, we are then effectively doing a discounted cash flow calculation that actually takes into account your business itself rather than just blindly taking listed company multiples and applying them to a valuation. So Graham, if we go to the next one's the last one. So the difference between the value and the offer price. So here we end off with something a little bit more practical and a little bit less theoretical. So the point is our model applies the techniques that any financial investor would actually use. And this is not the same as a strategic investor. It also doesn't mean that the offers you receive will be exactly the same as the answer given by our model, right? Because that would assume that human emotion doesn't exist. And that's a very silly assumption indeed. So a very personal example. I own a classic car. I have this beautiful Alfa Romeo that I love to death. If you follow me on Twitter, you would have probably seen it. It's worth a lot more to me than it would be to a purely financial investor. And I know this because I've turned down what were very reasonable offers for the car just because I don't want to sell it, actually. It's worth more to me than it's worth to a financial investor. Now, if Bisval was there to value classic cars, I know the value would come in probably around the levels I was given as an offer. But I'm still not selling it, and that's fine because a selling price is personal. So during the pandemic, for example, had you come and valued your apparel business with us, we would not have looked at a Nike valuation multiple or a Foschini Group valuation multiple and then said to you, oh, your business is worth this very inflated amount. But that doesn't mean that a potential buyer won't do it. A potential buyer might look at the markets and go, wow, everything is so incredibly valuable. Let me try and pick this up for a steal. I can buy this private company for 15x. Look at Nike, it's trading on 50. And the beauty of BizVal is if you then will run a valuation at that time on your own business and get what a decent financial number looks like without taking into account some of the cyclical craziness, you may well realize that, look, someone walking in and offering you 15x, that's a wonderful offer. You should seriously consider taking it. And on the other side of the coin, of course, if you are an investor, you can use BizVal as a way to manage your own excitement because people do get hot for deals. That's a reality. And, just to manage your emotion and to stop you potentially making a very silly offer, you can use BizVal to actually ground it a little bit and just see what a financial number should look like. If you still want to offer more than that to obviously secure the deal because you want a strategic company, or there's a reason why this investment makes so much sense to you, then that's different. So the point here is there is a difference between the value and the offer price. That's what makes a market. And what BizVal aims to do is give you a decent approximation of the value that a financial investor would look at. Thanks, Graham. I think that's me.
Great. Thanks, Ghost. And, there's a lot of theory in that, but, I think it's important sometimes to understand the theory so that the output and the decisions that you make from that are relevant. So I think before we move on to the Q&A section, I very quickly just want to highlight our next webinar series. So we're really excited about the next series. It's a two-part series, which will be on Wednesday as opposed to Thursday, Wednesday, the 22nd of Feb, and Wednesday, the 22nd of March. So 28-day month in February. So you only need to remember the 22nd and Wednesday for the next series. We'll be joined by two special guests and their partners. So we've got, and not as in their spouse partners, but partners from their businesses. So we'll have Matt Smith from Clever Profits and Andreas Sangarakis, I got the pronunciation right, from SCTV Attorneys. And they're going to be sharing some practical experience and tips in terms of moving from evaluation through to due diligence, through to selling a business. And what are the things that need to be in place? How does the process work? What are the things that you need to, do as you move from understanding the value of your business to potentially selling or even buying another business? So, we're really excited to have them join us, and please check out our web pages, be on the lookout for registration links for that webinar. I also just want to remind you all just to check out our podcast insights section on our website. The content and the recording will be there as well. So with that, it brings to a close our sort of formal presentation today. We'll now be moving into the Q&A section of the webinar. So again, just a reminder, if you have any questions, please pop them into the chat. But also, if you've got any tips or advice or experience that you've had, that you want to share with fellow entrepreneurs and participants, please pop it in there and we'll share it with everyone. So let's move on to the Q&A. There we go. So I think there's a question here, and to the Ghost, is we talk about discounted cash flows. But the question here is how do you value, and it might have been a question we dealt with in the past, but how do you value the brand? Okay, so cash flows on the one hand, but if I've got a brand, how do I value the brand, and how does that link into?
Yeah, thanks, Graham. So it is a question I think that comes up all the time, and I think that's a function of entrepreneurs just feel so passionately about their brands. I mean, I know we do. I know I certainly do. I think it's very natural. It's a very natural way to feel. And we always assume, the brand has got so much value. Like, even if the numbers are not so great this year, just look at the value of the brand. So look, sometimes the brand does genuinely have value. Of course it does. But unfortunately, I think as founders, we tend to overinflate the value of the brands that we've built, generally speaking. Unfortunately, it's just this cognitive bias that we can't get around. There's a lot of traumatic bonding that goes on between us and our brands. And, that leads to us believing they are worth a fortune. The reality is that if the brand is worthwhile, it should be coming through in your numbers. So unless the brand is really, really strong and for some reason the monetization plan around it is just not working at all, it should come through in the numbers. To value the brand separately is then not something that we try and do because it's really kind of bundled in with the rest of the business. it would be an unusual situation and something that's quite difficult, I think, to automate with an online tool. It's something we, certainly look at when we do these concierge valuations. Does the brand get properly represented by, the value of the cash flows that we're seeing in the business? If not, then maybe there's room to say, okay, the brand is worth a little bit more for a specific reason. But in general, no, we don't look to separately value the brand. It should come through in the financial performance of the business.
Yeah, thanks, Ghost. Here's a second question here from Patrick. It says, can we have a chat about the build-up of discount rate? So, I guess explaining what discount rate is, and is it standard or does it vary?
Yeah, so it's a really, really good question. And basically, it definitely varies per industry without a doubt. So, some industries are more risky than others, for example. Some industries, investors just like more than others. Some industries are very defensive. Others are cyclical, for example. So what we've done, in the tool, when we ask people, okay, what industry is your business in, then we are using that answer to go and apply some logic around, okay, what would be some of the adjustments that we would typically make to the sort of standard discount rate in the market for a business in a specific region. So the discount rate is a complicated thing in and of itself. Firstly, it varies by region. So the discount rates in South Africa are not the same as they are in the UK, are not the same as they are in the US, for example. And there are macroeconomic reasons for that, which is probably just way beyond the scope of this webinar, really. But within that, we then look at the sector. So there's a difference, once again, between a restaurant that is 2 years old, we know how super risky that is, versus, for example, a software as a service company that's been around for 10 years. Those two things just cannot possibly have the same discount rate. So to answer the question, it varies per industry. Obviously, we would all love it if there was an exact answer to the 5th decimal place on exactly how to do this. This is half the problem with valuations, is there is technically no right answer. There's just a reasonable range in which to have a negotiation. That is the kind of art and science of valuations that I think we've covered in previous webinars. So we try and adjust accordingly and take into account, what we've seen in practice, what you can observe in the markets, and sort of investor sentiment as well, and keep that as fresh as we can. And we have this like feedback loop all the time, where we're speaking to people in the market, we're seeing what they're up to, we're looking at what's happening with listed companies, notwithstanding the huge distortions we covered on this webinar, and we try and adjust accordingly.
Great. There's a sort of follow-up around discounted cash flow, and probably quite a technical question, guys, but it says, when you DCS for future cash flows, how does one add retained income to this if it wasn't declared out of, prior to sales? So perhaps you can just deal with that.
So retained income is an accounting concept. So discounted cash flows only care about cash, not what people learned in their 4th year at WITS. I have a lot of trauma from that, so you can see that memory is still fresh. And the point there is, if there's cash in the business, if there's excess cash in the business, then absolutely we add it in. I mean, just logically, imagine you are selling your business and for a fact there's $1 million in the bank that you don't need to run the business. It's just sitting there. If someone's going to buy the business from you and you're going to hand over the keys to your R1 million, they must pay you R1 million more, right? They're just getting cash. Or what you would do is you would actually declare it out before selling, which is quite common. And then you sell a sort of clean balance sheet that has enough cash for the operations, but nothing extra. So one of the questions in our model is, how much excess cash do you have in the business? And that's exactly why we ask it, is so that you can then add it in and take that into account when valuing the business.
Fantastic. I think a question for Howard. I'm going to just jump around in the order a little bit. Once I know what the value of the business is, how do I use that information? Just to plan ahead to go north, or how else do I use that info? And Howard, I'm sure you've got a few stories and practical insight around that.
Yeah, look, it's a great question, and I think it's something that everybody considers, and it's true. Once you've done the valuation, what do you do with it? I think to get clarity on that, you've also got to consider, how is it that I can enhance that value? So are there things within my business I can do that enhance it? For example, some of the businesses, Graham, you and I have consulted to, we've been able to help people look at the growth drivers and look at aspects within their business that they need to adjust in order to enhance that value, and then focus on those growth areas and focus on those enhancements to further drive the business. Otherwise, what you do with the information that you have is you could be assisted at that point to put together an information memorandum and maybe circulate it amongst people that might be interested in acquiring this kind of business or attract investment into the business to allow it to grow. But once you have your drivers of your enterprise value correct, those are logical processes that follow. And I must say, it's one of the things we discussed prior to this, where you asked me, of the valuations that I've been through, how far were the buying prices off those targets? And I have to tell you that once the valuation is done properly, the deals normally close well within the range of what was suggested in the valuation. And that's been my experience in all the transactions I've done. Good valuation on proper principles, like we discussed today, and you'll realize that price.
Yeah, I think maybe leading to the next question, Howard, and perhaps Ghost wants to jump in here too, is your suggestions on both the need to manage upfront, the exit methodology, as well as in how to, or recommendations how to set these in place would be appreciated. This can have nasty consequences because of shareholder valuation, divergence, and exits. So, yeah, how maybe you want to just jump in there to start. I guess you're talking about that sort of expectation gap, and Ghost, maybe from a technical aspect, you want to jump in here too.
Yeah, I think the most dangerous thing is everyone's a balance or a spreadsheet billionaire. That's very dangerous. We all know that if you overvalue your business based on the sentiment that you feel around your brand or the goodwill, whatever you want to call it, you can create an unrealistic expectation in your own mind, only to be grossly disappointed once the valuation process is run. So I know in all the transactions I've done, we were approached by acquiring parties, valuations were done, and then negotiations commenced. So I think BizVal is an extremely valuable tool that gives you a realistic range to see what your business is worth within a range, and then you're able to have a realistic discussion. It might be that you want to attract capital, it might be you need a business partner, it might be that you just want to sell and exit. But like we've always said with BizVal, for us it's building a dividend-rich business or an EBITDA-rich business, one that's cash positive. And with a business that's cash positive and the enterprise value being addressed and growing correctly, you can do. Then you have the choice to do whatever you want with your business, as opposed to having to do a desperation deal because you've traded yourself into a situation where you're either cash compromised or you've just lost your love for what you built.
Yeah, I mean. Sorry, guys. Yeah, I think there was an add-on to that question around this question is for when one founder wants to exit as well. So I think, guys, perhaps you can jump in on that aspect. Yeah, and I get that. Is you've got partners and one wants to go. How do you?
So I've seen lots of shareholders agreements that actually try to deal with this, and one of the things I've seen in practice is when you kind of enter into these deals, you go through an entire valuation methodology, and what you end up with is an inferred multiple. So you go and do a discounted cash flow, and we actually do this when we do quality reviews on valuations that our system is kicking out. Is we'll take the final answer and say, okay, what multiple is it inferring? Because the problem is if your shareholders agreement says something like, don't worry, we'll do a DCF in 3 years' time and everyone will be friends, it's basically guaranteed to end in a fight. Whereas if there's actually a valuation up front and you arrive at a blended answer and you figure out, okay, based on our current profits, this is an EBITDA multiple or earnings multiple of 6x. Fine. In 3 years' time, if one of us wants to go, we consolidate, guess what? 6x on whatever the earnings are then. So a lot of shareholder agreements do not assume that the multiple will change. It just says, obviously, as you create better earnings in the business, the valuation of the company goes up. If the earnings go down, the valuation goes down. If you try and agree multiple expansion and contraction, I think that is when the fights get in a big way, because that has a huge impact on valuation. On a 5x valuation, if you move that multiple by 1x, you've changed valuation by 20%. And that is where the fight starts.
I think maybe just to jump in there, I mean, it's not really a BizVal comment, but we've seen that in terms of people using BizVal. Things like buy and sell agreements and insurance for, if there's a dispute down the line, are actually really important in this space. A lot of people don't have those, and that also creates a lot of discontent when a partner dies or wants to exit or something happens unfortunate. So it's just something else to think about. As a business owner, always think about that key man insurance, the buy sell insurance, and it's also a way of kind of mitigating some of that risk down the line. Very quick question. So I think I skipped over that. It said when valuating small entities and the owner managers earn a non-market linked salary, so either too high or too low, how do you normalize for the managing director salary in your DCF models? I think very briefly, that's a great question, and it's true in practice. A lot of owners pay themselves last, while the business is growing. And then I guess I shouldn't say this, as the business gets bigger, they pay themselves first, and enjoy the fruits of that. But for an external buyer, what they're going to look and say is, what would I pay a professional manager to run this business if the owner stepped out? So we adjust for that in our model. We take a view on what a managing director or owner for this business should be being paid based on the size of the business, the industry, the sector. So we kind of replace whatever they're being paid with what I guess is a normalized view of what the owner should be paid. So hopefully that answers that question. And then I think the last question, unless there's any others that pop up, is in the UK, private equity businesses are valued using the multiple approach. And this is what's happening in practice. So what would you say is the best way to assess the valuations of these private businesses that are being valued using the EBITDA multiple approach? So Ghost, I'm going to ask you to tackle that one, and then we can...
Sure, Graham, I think there was one other one we've missed. So what I'll do is I'll answer this one. I'll just jump into the other one, and then I think we're probably done. So it's not just in the UK that private equity businesses are valued on EBITDA multiples. It's everywhere. It's stock standard in South Africa as well. The reason, this is quite technical, but the reason private equity uses EBITDA multiples is because it takes out the balance sheet. So what I mean by that is it ignores the amount of interest being paid. It ignores the amount of depreciation, which is always where distortions can come in. When private equity looks at a business, they look at this and say, okay, what are the assets worth? And we will then decide how to fund them. So what an EV/EBITDA multiple does is it actually says, what are the operating assets ultimately worth at the end of the day? Because private equity will often come in and inject an absolute ton of debt. At the very least, they will restructure the balance sheet. Chances are that the existing debt's going to go away because they will use their own relationships to come in and put in the debt they want. And so using price earnings multiples just distorts it terribly, right? Because if you've got a lot of debt on the balance sheet, your earnings will be a lot lower than if you don't have a lot of debt on the balance sheet because you have to pay interest, right? You have to pay some of that away to the bank. It doesn't tell you anything about what the assets are worth. Your net profit tells you very little about what the assets are actually generating because there's so many distortions underneath that. So that's why private equity goes that route. It's also why we include that route as well. It's important. It takes a lot of nonsense out of the system and a lot of accounting distortions as well. So, we basically, long story short, is there are good reasons why private equity does that. And we also include an EBITDA multiple in our approach as well. And Graham, if you don't mind me just doing the other one that I think we, Tim, that's it.
I think it was from Tim.
So the question was, recalling from an earlier webinar that a buyer can use BizVal to value a business from their point of view rather than the owner of the business. Can this be done on the platform using data from the annual financials? What other information would be needed? So most of what we ask is from the annual financials, yes. You do need to have your own view on stuff like the expected growth in the business. But honestly, as the buyer of the business, you need a view on that anyway, right? You're going to buy it because you think it can grow at 10% or 20% or 5% or whatever the case may be. So you should be able to do it. I mean, there might be one or two intricacies where you're going to have to squint a little bit and you might be slightly wrong. But honestly, the sensitivities to some of those inputs are not so high, and you'll get a pretty decent valuation range. And you can always go and refine it later on, just double check or just see how far off your range you were. And I think you'll find it'll still be a very useful tool.
Yeah, Tim, if you have any more questions, feel free just to email us and we'll get back to you.
There's one more, Graham, on property.
A bit deeper than that. And then I see one more come through at the 11th hour.
So property is a fun one, right? I mean, often it's a cap rate, so it's net operating income. Oh, sorry, yeah, you're right.
Sorry, just ask the question.
So the question is, in property, we build up a DCF rate based on the long bond returns, that means government bonds, plus property, tenant, and locational region risk. How does this differ to business valuations? Okay, so basically, when you do a property valuation, I've seen the word cap rate used a lot. It's a little bit like a DCF rate, but not quite, because what you would do is you would work out the net operating income in the property and then say, what is the yield that an investor is demanding from this property? Now, obviously, if it's an inner city, residential unit where you need to go and collect your rent and it's a bit risky to even drive there, that is very different to leasing out a warehouse to ShopRite. Those are not the same thing, right? So the returns also need to be different. Same way in any business where you will measure for risk, same thing you will do in the cap rate on a property. And property is a bit like a bond. So the higher the cap rate, the lower the value. There's always an inverse relationship between the rate at which you discount it and what the value actually is. So a lot of the concepts in property are quite specialist. You know, you have to look at stuff that is not what you would look at in another business, but the concepts are not that different. Location and region risk in property just means business model risk in a standard business, for example. Your tenant risk in a property is not dissimilar to revenue quality in a normal business. You know, where are you actually earning your money from? It's the same as having a tenant in your property. And the LON bond, etc., that is the macroeconomic measure that says in South Africa, you know, if LON bonds are trading at 10 or 11, you can go and buy a government bond and that's your return. So it doesn't help you if your private company is making you 5%. The thing's worthless. Sorry to burst your bubble, but you can make that risk-free in a money market account. So these are the macroeconomic things we take into account. And yeah, so property is specialist. We have not built our model to do property, but actually the underlying concepts are not that different.
Great, thanks, guys. So I think that brings to an end our webinar for today. Once again, thanks to all of you who joined us today. Thanks for the questions and the engagement. We dealt with a couple of things today. Some of the topics quite technical, but hopefully you took some value out of that. If you want to recap on that, as I said, the webinar will be available on our website on YouTube. And we look forward to having you join us for our next one towards the end of February. So thank you, everyone. Have a wonderful afternoon and hope to see you all soon.